Here we will walk through a question related to the issuance and conversion of bonds. The following are unrelated transactions. On March 1st, 2020, Loma Corporation issued 300,000 8% non-convertible bonds at 104, which are due on February 28, 2040. In addition, each $1,000 bond was issued with 25 detachable stock warrants, each of which are entitled the bondholder to purchase one of Loma's no par value common shares for $50. The bonds without the warrants would normally sell at $95. Loma prepares its financial statements in accordance with IFRS. Grand Corp issued 10 million par value 9% convertible bonds at $97. If the bonds had not been convertible, the company's investment banker estimates they would have been sold at $93. Grand Corp has adopted ASPE and would like to explore all options available to report the convertible bond. Hussein Limited issued 20 million of par value 7% bonds at $98. One detachable stock purchase warrant was included with each $100 par value bond. At the time of issuance, the warrants were selling for $6. Hussein Limited has adopted ASPE. On January 1st, 2020, Tian Limited called its 9% convertible bonds for conversion. The 10 million of par value bonds were converted into 1 million common shares. On July 1st, there was 75,000 of unamortized discount applicable to the bonds, and the company paid an additional 65,000 to the bondholders to induce conversion of all the bonds. At the time of conversion, the balance in the account contributed surplus conversion rights was 270,000, and the bond's fair value, ignoring the conversion feature, was 9.955 million. The company records conversion using the book value method. On December 1st, 2020, Horton Company issued 500 of its 1,000 9% bonds at 103. Attached to each bond was one detachable stock warrant entitling the holder to purchase 10 of Horton's common shares. On December 1st, 2020, the fair value of the bonds without the stock warrants was 95. Horton Company prepares its financial statements in accordance with IFRS. And then we're asked to prepare the required journal entries to record each of the above transactions. For transaction number 4, prepare the journal entry if Tian Limited prepared its financial statements using IFRS and if it uses ASPE. All right, well, let's get started with number 1. So journal entry for number 1. So we're told on March 1st, 2020, Loma Corporation issued 300,000 8% non-convertible bonds at 104, which are due on February 28th. In addition, each $1,000 bond was issued with 25 detachable stock warrants. So we've got a bond with warrants. So we've got a hybrid financial instrument here. So we've got a bond and we've got warrants, each of which entitled the bondholder to purchase one of Loma's no par value common shares for $50. The bonds without the warrants would normally sell at $95. And Loma prepares its financials in accordance with IFRS. So IFRS requires us to value the debt first and put the remainder of the value to the equity component. So from this, we know that the bond is 300,000. And we know that the bonds without the warrants would normally sell at 95. So we can value the bonds. Let's go here. So we've got the fair value of the bonds without the warrants. Is going to equal 300,000, which is the face of the bond, times 95. Because in the question up here, we're told that the bonds without the warrants would normally sell at 95. So that's the best information we have to be able to value just the debt separately. And IFRS requires us to value the debt separately, and that's going to give us 285,000. What did we actually receive in cash? Well, we sold 300,000 of bonds at 104. So this is the fair value of the debt. If we take 300,000 times 104, that is going to give us 312,000. And this is going to equal cash, which is debt plus conversion or warrant. So what we're going to record here then is we're going to say debit, cash. We definitely received 312,000. What we need to do is figure out how to split this 312,000 that we received between the debt and the equity. The way that we do that in IFRS is we value the debt first. So we're going to have bond payable. We're going to have 285,000 here. And the remainder simply goes to contributed surplus in relation to the warrants. Contributed surplus, warrants. And this is going to be the balance, which is simply $27,000, simply the balancing piece of this entry. And this has enabled us to split the accounting between the warrant and the option. Sorry, the warrant and the bond. Okay, so we've got one done. Number 2, Grand Corp issued 10 million par value, 9% convertible bonds at 97. 10 million, okay. If the bonds had not been convertible, the company's investment banker estimates they would have been sold at 93. And Grand Corp has explored ASPE and would like to explore all options available. We know that there's some accounting policy choices under ASPE. ASPE can permit us to value whichever piece of the instrument, the hybrid instrument, is the easiest to value, and then put the remainder to the other piece. Or it can also choose to value the equity component at 0 and put the entire amount towards the debt. So let's see what this looks like. So we've got ASPE. So let's figure out what did we receive in cash here. So we got 10 million at 97. This is the cash that we received. So let's go number 2. We've got ASPE here. So let's go cash. So we've got 10 million times 97, which is going to give us 9.7 million. This is cash. So this is debt plus warrant. Okay, now what can we split out? So in this question, we're given the information to split out the bonds. So we're told the bonds would be sold at 93. So we need to value that's all the information that we have. So we've got the debt would be 10 million times 93, which is going to give us 9.3 million. This is debt only. And we'll put the balance to the conversion rates. So let's record our entry. So we're going to have debit cash. We're definitely receiving 9.7 million of cash. We calculated out the bond payable, which is going to be this amount here, 9.3 million. And the remainder is going to go to our equity component, which is recorded through contributed surplus, warrants, or conversion rights. And the balancing entry here is going to be 400,000. So that's one option. So this is value easiest component first. And in this situation, that was the debt because that was all the information that we were given. ASPE could also value the equity at 0, in which case we know this number, we know our cash. So in which case our entry would simply be debit cash, 9.7 million, credit contributed surplus, conversion rates or warrants, and 9.7 million. So in this situation, we're not trying to split, we don't even try to split out the debt and equity. We just say, we'll just assume that we've made an accounting policy choice under ASPE. We're going to value the equity component at 0. Okay, let's go up. So that's number 2. Number 3, Hussein Limited issued 20 million of par value 7% bonds at 98. One detachable stock purchase warrant was issued with each $100 par value bond. At the time of issuance, the warrants were selling for $6. Hussein has adopted ASPE. So under ASPE, we can value whichever component of the hybrid instrument is easiest to value first, and then put the balance to the remaining piece, unless we want to record the entire amount to equity. So in this situation, we're told what the fair value is of the warrants. So we're told the warrants were selling for $6. So let's do our journal entry here. So 3. So we're doing ASPE here. IFRS would require us to value the debt first, but ASPE says we can value either component first. So we're going to have, let's figure out our cash first. So we've got 20 million par value, 7% bonds at 98. So 20 million times 98 is going to be our cash. $20 million times 98, which is going to give us 19,600,000. This is our cash. Then we've got to figure out the value of, so then we've got the warrants. So we've got the warrants, which are, so it says that $20 million bonds, but each bond was worth $100. So we need to go 20 million divided by 100 to figure out how many bonds we have, because each bond came with a detachable warrant. So we need to say, okay, so for the warrant, we've got 20 million divided by 100, I think, divided by 100, which is going to give us, is it 100? Just double check. Yeah, 100. So that's going to give us $20,000. $200,000. And each warrant, we're told, was trading at $6. So that's going to give us 1.2 million for the warrant. So we can simply balance the other side to the debt. So we're going to go debit. Here's our journal entry. Debit cash. We're going to get 19,600,000 in cash. We're going to go credit contributed surplus. Warrants. This is going to be the 1.2 million we just computed. And the balancing entry is going to be to the bond payable, which is going to be 18,400,000 based on the math to balance that entry. Of course, ASPE could have also just said, listen, we got cash of 19,600,000, so we'll just record the bond payable at 19,600,000 and assume that we made the accounting policy choice to value only the debt and ignore the equity component. Okay, so we did 3. Number 4, on July 1st, TN Limited called its 9% convertible bonds for conversion. The 10 million of par value bonds were converted into 1 million common shares. On July 1st, there was 75 million unamortized discount applicable to the bonds, and the company paid an additional 65,000 to the bondholders to induce conversion of all the bonds. At the time of conversion, the balance in the account contributed surplus was 270,000, and the bond's fair value, ignoring the conversion feature, was 9.955 million. The company records conversion using the book value method. What is the book value method? The book value method means that aside from inducements, there would be no loss on settlement of the debt. The entire amount just flows through the common share account. However, inducements will create a loss on settlement for the exact amount of the inducement. So let's do our journal entry here. 4. And actually, let's go back up to the question for a second here. This is a lot of work we got to scroll through. So remember here in the question it said, for transaction number 4, prepare the journal entries under IFRS and ASPE. So let's start with IFRS for number 4. Okay, so we're told that the bonds payable. So we know we need to clear out the bonds payable, which is a credit on our statement of financial position. So we're going to debit it to clear it out. And we need to debit contributed surplus, which is also a credit. So we're going to clear that out. Contributed surplus, warrants. We need to clear out those amounts. We're also going to have, so the company is going to need to record the conversion feature, and we are going to need to issue common shares. So we know that we're issuing common shares. That's the whole point of exercising these warrants. And we're also going to have a loss on conversion, a loss on debt or debt redemption, let's say. And we're going to need to pay out the inducement to the shareholders now, because that's the whole point of us inducing them to convert their options. We've agreed to give them $65,000 of cash. So the inducement was for $65,000. So that's how much we're going to have to pay out. And that's also going to be the loss on the redemption of bonds under IFRS. So those amounts are exactly the same. Then we need to find the carrying value of bonds payable and what was left in that contributed surplus account, which it did give us in the question. So we're told that there was 75,000 unamortized discount applicable to the bonds. The company paid 65,000. The balance in contributed surplus was 270. Okay, 270, and the bonds were 10 million, and there was an unamortized discount of 75,000. Okay, so let's remember that 270. So this is what we're going to clear out here is 270. It's given in the question. And bonds payable, we're told that there are, the bonds are 10 million. And there's an unamortized discount of 75,000. That is going to give us, let's see. It's going to give us 900 and oh, sorry, here we are. 992500. 9925000. So that is what we're going to clear out of our bond payable account here. 925. So our common shares is going to be the difference. So everything washes through the common share account other than the inducement. So therefore our common shares are going to be recorded at 10,195,000, which is simply the fact we know that we've got the loss on redemption 65, which is pretty clear. These two amounts are very clear in our IFRS entry. We were told that there was an unamortized discount on the bonds of 75,000. We know that the bond face value is 10 million. That gives us this amount that we would need to clear out from our statement of financial position related to the bonds payable. It's basically telling us that this is what we have on our statement of financial position. So we're simply clearing that out. We're told that there's a balance in contributed surplus of 270,000. So we're going to clear that out. And we know that we paid out this cash for the inducement. So therefore the balance is simply going to go through our common share account. That's the equity that we issued, that we actually induced these hybrid financial instrument holders to convert into common shares. Now let's take a look at how that entry would be different under ASPE. Some of it would be the same, but there's a couple pieces that would be different. So we're still going to have the ASPE is going to require us to allocate the 65,000 that we received as the inducement. We need to allocate it between the debt and the equity. IFRS simply said we could put it through as a loss and then record the cash. But ASPE needs us to bifurcate the 65,000 inducement that we received. So how are we going to do that? Well, let's figure out the piece to do with the debt. And the way that we're going to do that is we're going to say the fair value of the debt minus the carrying value. We know the carrying value, we're given it in the question. The carrying value is the 995,000. Actually, sorry, we need to look up at our ASPE journal entry because we had a different entry when we recorded the debt. So looking up here, we had the debt was recorded at, I wonder how this worked. 995,000. Okay, so the carrying, okay, let's look up at the question. Hang on, sorry, I'm getting a bit lost here. So let's go up to the question. So we've got Tian called its 9% convertible bonds. The 10 million par value bonds were converted into 1 million common shares. On January 1st, there was 75,000 unamortized discount applicable to the bonds, and the company paid an additional 65,000 to the bondholders to induce conversion, contributed surplus, and we're told that the bond's fair value was 9.955 thousand, and that's the information that we need here. So the fair value is only required for the ASPE journal entry. We don't require it for IFRS. So we've got the fair value here is going to be 9,955 million. And we know the carrying value of these bonds. The carrying value was the 10 million minus the unamortized 75,000, which we had up here in our journal entry. So it was 9,925. 9,925,000 or 9.9 million. So the difference between these two things is going to give us our loss on the redemption of the debt. So the difference between these two things is going to give us $30,000. This is going to be loss on bond redemption. So that's going to be the piece of the $65,000 inducement that we're going to allocate to the debt. And then the equity component is going to be the remainder. So we're going to say 65,000 was the inducement. We've now allocated 30,000 to the debt. So the remainder of 35,000 is going to be allocated to the equity. So you can see the sum of the 30 that we're going to allocate to the loss on the bonds and the 35,000 that we're going to allocate to the equity sums up to our $65,000 inducement. So let's record our entry here. So we're going to have debit, bonds payable. We know we still need to clear out the bonds payable. And we need to clear out contributed surplus, warrants, So bonds payable has a carrying value. We were told it's got that unamortized discount of 75,000. So just like in IFRS, we've got the same carrying value here based on the question. We're also told that there is a balance of 270,000 in contributed surplus related to these warrants, so we need to clear that out. We're going to have a debit on loss on bond redemption, which is going to be this amount we calculated right here, 30,000. And we're also going to have a loss on the equity piece, which we don't put to contributed surplus. This goes right to retained earnings. We've cleared out contributed surplus, so there's nothing we can put through there. So we're going to put the 35,000 that we calculated for the equity component through retained earnings. Then we're going to record the cash that we have to pay out to induce the conversion. We still have to pay out the 65,000 regardless of how we're allocating it. And we're also going to recognize the common shares, because again, that's the whole point of inducing this conversion. And this is going to be the balancing entry. So the sum of the bond payable and the contributed and the common shares is going to give us 10,195,000. And that is how the journal entry looks under ASPE. So the main difference between IFRS and ASPE is that under IFRS, we simply recorded a loss on debt redemption of the exact same amount of the cash that we paid out for the inducement. And then we simply cleared out these values and the balance goes to common shares. With ASPE, the only difference is that we weren't able to record the loss on debt redemption of the 65,000, which ASPE said, no, this whole thing isn't related to the debt redemption. Part of it's related to the redemption on the equity or the warrants that are being exercised. So therefore it said we need to split the 65,000 inducement between the debt and the equity. The way we split it on the debt was to compare the fair value of the debt with the carrying value of the debt on our statement of financial position, which gave us a loss on bond redemption, which we recorded in our journal entry right here. And the other part, so the balance of the inducement was then allocated to equity, which goes through our journal entry as a debit to retained earnings, decrease to retained earnings. Of course, we still had to pay out the cash of the 65,000 for the inducement, regardless of how we allocated it in our debit entries. And we issued the common shares, and the balance of everything goes through our common share account as reflecting the amount of equity that we've issued. Okay, let's go back up to the question. So now we've done 4, we've got one part left. On December 1st, 2020, Horton Company issued 500 of its 1,000 9% bonds at 103. Attached to each bond was one detachable stock warrant, entitling the holder to purchase 10 of Horton's common shares. On December 1st, 2020, the fair value of the bonds without the stock warrants was 95. Horton prepares its financial statements in accordance with IFRS. Well, we know IFRS is going to require us to value the debt first. So it says the fair value of the bonds without the stock warrants was 95. So let's do that entry. 5. So we've got the value of the bonds, which is going to be, let me just take a look at that question again. So 500 of it's 1,000. Okay, so 500 times 1,000, which is 500,000. And the value of them without the warrants was 95. So we're going to go 500 times 1,000 face times 95 is going to give us 475,000, which is the debt. The cash that we received was 500 times 1,000, the face times 103, which we were told in the question, which is going to give us 515,000 cash. So this is debt plus equity. So therefore, we're going to allocate the balance to the equity. So our journal entry is going to be debit, cash, because we're receiving cash for issuing these hybrid financial instruments, credit, bond payable, which is going to be 475,000. Oops, is that right? No, sorry. This should actually be 515. 515,000 is the cash. Sorry about that. Then this is going to be 475,000. So we calculated the cash here. This is the debt, 475. And the remainder is going to go to contributed surplus. Warrants. And the balancing entry here for the equity side is going to be 40,000. And that takes us through that part of the question, number 5. And it looks like we've concluded this question. Great job. Those were a lot of journal entries to do with warrants, but I think we made it through, and hopefully you learned a lot throughout the process.